Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest. We've got Bryan Amos with us. Bryan, appreciate you coming on the show.
Hey, Darin. Glad to be here. Excited to participate in the podcast. I've heard about it for a long time.
Fantastic. Well, just a little bit on how Bryan and I know each other, and then we'll jump in. But so Bryan, when I first got my first syndication deal, one of the things I was scared of was, I'm not an engineer. And I was like, how do I know that I'm buying a property that doesn't have a bunch of issues structurally or otherwise? And, thankfully I had joined a group, the Brad Sumrock group. Both of us are part of that group. And I met a lot of other syndicators, and they're like, just hire Bryan. And so I did, and he helped out in a tremendous way. So I'm very interested in this conversation, and I think the listeners are going to benefit tremendously from it. So with that, can you share a little bit on how many properties and how many units you're invested in? And, maybe because you're on the due diligence side, share a little bit about your background there as well.
Sure, no problem. Been doing due diligence for 13 years. We've assessed over 80,000 units, several hundred properties, and all ranges, D class to A plus, and have transitioned over the last few years to also be an apartment investor, and that's how we've met. We are in the same investing group, and currently I'm general partner in 3 properties, 832 units. So 2 larger properties, 300 plus units, and then a 160 unit property in Irving we just closed on earlier this year.
That's awesome. As I alluded to earlier, I hired your firm, which is called the Omni Group. And, I did that based off of, recommendations from other syndicators because I was like, look, I don't know if there's foundation issues or if there's, plumbing issues or whatever. And they're like, don't worry, just call Bryan. And so I did. I called you on and hired your company. Explain a little bit to the listeners, like what you guys do when you come on property and when.
Sure. Right. So I think we approach it a little bit differently than what you may expect if you have experience in, a home inspector, you're selling a house or you're buying a house, you get a home inspector. We're that for apartments, only for the investor. I think that's an important distinction. For example, when you get your home inspection, it goes to the buyer, right? It's the buyer. And in this case, in multifamily, the lender is the one who authorizes, engages the inspection company usually, right? So it's on the lender side. So the lender is looking to protect themselves. And I saw a gap there where we would get this property condition assessment from the lender, and it wasn't from the investor's perspective. And so I created this with another investor who had a property management company, and they had a due diligence checklist of all the things that you needed. And me from the construction side, because at that time I've been a general contractor for 6 or 7 years, and this was back in 2009. And we put this together for the investor. And so, like you said, you hired me. I'm your advocate to make sure that there are no big problems on the property, and then sketch out the initial costs for the first year on those major categories. And your interests are my focus. And if you get it from the lender's trying to protect themselves. So that's where we came up with these major categories that we would cover for due diligence.
So what are those major categories?
And I think this is an important distinction, for your listeners, that if you get a lender's PCA report, it's by engineers, kind of for engineers. And so they may break it up in different categories. And so as an investor and someone who's renovated properties, we based it on who's going to actually do the work. Now, some of these are obvious. The roofer does the roofing, foundation company does foundation. But when you get on interiors, who does the flooring, who does the cabinets, who does the exterior, maybe the carpenter or the metalwork, and you can kind of the way those are divided up in a PCA is a little bit unclear. Who does the work? So we make sure we have one party responsible for exterior repairs and then interior repairs. So two major categories. Of course, you have your roof, your foundation, your plumbing, the sewer line side, and then the domestic hot water side. So you have your sewage, and then your potable, your domestic hot water that's used for your showers and inside the units. Then you have parking lot, termites. Now termites is usually not a deal breaker, but it's always required by the lender. So it's something we check. HVAC, and then electrical. So those are your major categories. We also throw in exterior lighting. It's never a deal breaker, but usually the electricians out there, they're checking the panels. They check the lighting as well.
So listeners, think about this. If you're going after your first deal, like I was when I hired Bryan, like you get a deal under contract, and then maybe you're not a due diligence guy like myself, and I had no idea how comprehensive this was going to be. And if I had to do it alone, right, I would have had to call the plumber. So basically, I hire Bryan's company, and then I show up for due diligence, and he has brought all those different skill sets, different companies that specialize. So he's got an electrical company there. He's got a foundation company there. He's got an AC company there. And so they're going and looking at all the facets, and then they report to Bryan, and then Bryan summarizes it to me, as the investor. And that was such a breath of fresh air. In addition to that, Bryan's walking me around the property, pointing out, hey, you see this, you, depending on how long you're looking to hold it, you may want to do this, you may not want to do this. So he's providing value and he's giving guidance. Now, you're the ultimate decision maker on how you're going to spend the rehab money, but he's got, the experience of reviewing over 80,000 units. So why would you not listen to this guy? So I was very thankful.
Well, appreciate that, Darin. And point out, so I'm not necessarily the expert, so my business model is I'm a coordinator of experts, because, I've learned a few things about electrical and a few things about plumbing over the years, and have some training and some different study that we've done, but I'm never going to beat a plumber who's been around for 30 years or a master electrician that's what they do day in, day out. So we contract with these companies to give their professional opinion and actual bids for that work. So a little bit different than what a lender will do. Lender usually has one representative, one person that comes out, and this guy or gal will review the property for an hour, maybe 2 hours, and walk a sample number of units, and then give you a summary based off, kind of their tables that they have to do pricing. So totally different getting an actual bid from a contractor, and we provide all that coordination for the investor.
Yeah, that's huge from a number of different aspects. One, from the investor standpoint, I can take action from one of the quotes that are included in your report, immediately after purchasing the property, but I'm not required to, so, you're bringing all these experts on and they're providing quotes for doing the work. But if I have another general contractor that I want to use, I can use that general contractor for one or multiple or all the pieces. And, even if I don't use the vendors that Bryan brings, it's another bid that I can compare to another GC that I might be working with. So it's invaluable.
Absolutely, right? So sometimes they ask, like, do we have to use this contractor or this sub? No, this is supposed to be a real world, accurate proposal for you to use. Again, we're on your side. We're the investor's advocate and give them the resources so that they can make quality decisions based on their business plan, not based on some lender's criteria. Well, these are deferred maintenance. You have to do these certain things. Well, we want to give you the big picture, and then the control is in your hands to make those decisions.
Yeah, I mean, that's huge because in the beginning, as the investor, you're putting together the rehab budget, and, having somebody that is on your side, like Bryan, to be able to say, where should I be spending the money? Because that's a big part of being a syndicator and being the lead on a deal is knowing where to put the money and where you're going to get the most value from. But there's certain things that you can't get away from. If the plumbing clogs up, you have to fix it, right? And so knowing that up front and budgeting for that is crucial. Absolutely.
And different ages of property affect your business plan. So, for example, I currently own a 1960s property that has cast iron sewer lines.
Oh, I'm so glad you're talking about cast iron sewer lines because I want to know about that because I've got a property like that too. It's just a nightmare.
So the problem with cast iron is they were designed to last about 50 years. And unfortunately, I was born in the early 70s and I'm approaching 50, right? So anything in the 60s is over that. And it just shows some signs of deterioration, kind of like me, all my joints don't work the same as I did when I was younger. Well, these cast iron pipes and the maintenance guys and different plumbers over time, they roto-rooter those lines, they hydrojet them, and they start to deteriorate, and just the they start to rust and flake, and so over time you have these weak spots and the sewer lines break. So it wasn't until the 1980s where they switched to PVC, which those lines last longer. So anything in the 70s and 80s, you have a high likelihood that you have cast iron pipes. Now, I wouldn't necessarily, this is like this particular property that I own, 1960, it's performing tremendously, doing well. But it's something that we have to budget for initially. We did some initial repairs, and then we know that that's an ongoing cost that we must kind of account for this older property.
Yeah, that's very important. Is that you could still buy these properties, but you have to be able to budget for the repairs and maintenance. If you don't budget for it, it's going to eat into the cash flow you thought was going to investors. On the cast iron pipes, I'm going to ask you a few questions here because I want to learn.
Sure, no problem.
I've seen some cast iron pipes at one of the properties I'm involved with that literally like cracks, like just, they're not repairable. I mean, they're just cracks all the way down the pipe. And, the guidance from the plumbers is that they got to cut that piece of the pipe out and then put PVC up and then kind of latch that onto a good part of the cast iron pipe. So one, is that a good approach? And it's very costly to replace the entire, cast iron to PVC. And then an investor actually brought up to me, and I've never heard this before, so I don't know if this is, just a commercial, or if it's real, but there was something called cast iron pipe lining repair, where they basically go in and then put like PVC inside the cast iron pipe versus having to like cut the wall out and then cut the pipe and then replace it with PVC. So that's a lot, but I'm interested in that detail.
So let's start back where you first started. The pipe does literally disintegrate and have cracks, and you cannot do it. Like, there's nothing to patch that crack, and you do have to cut it out, and your next clean piece of pipe is where you have to attach to. Now, I'm most familiar with making that repair with PVC. So that is a recommended repair, especially if you're going vertically. That's something where you typically use PVC for your sewer lines. One of the big difference with how maybe a maintenance guy would do this repair versus a plumber who's doing it the right way is how they do those connections. So you may have
connection between the PVC and where it latches on
and the old cast iron, right?
Right.
So the cast iron, you found a good section. How are you making that connection? Because what you don't want is 6 months from now that shifts and you end up with another area that blocks flow and you have a backup in just a couple of months. And that is very common to have quick plumbing repair done by maintenance. They dig down, so a rubber gasket, fitting. You want to make sure that it's properly connected, that the pieces meet, and that they have a secure fitting to connect that line.
So what
and
would
that
be
doesn't
a
shift.
secure fitting? I'm not of that world. So
not just a bracket that you get from Home Depot is really. So you make sure that you have a complete fitting on both sides of the line, and that doesn't move. You're trying to avoid this up and down movement when the two lines meet.
Gotcha.
Because we're in North Texas, which is unusual for some people, but our soil moves. It shifts over time, and we have a clay soil, high content of clay, and it's elastic. So you do your plumbing repair, and over time you get a lot of rain, or you get a lot of, or it doesn't rain, and that soil will move, and it'll break those repairs.
Gotcha.
So you have to be able to take this up and down movement that we have in North Texas.
So that's interesting. Now, how do you, because you guys go in and do due diligence ahead of time. First thing you see is, hey, this property has cast iron pipes. It's evident, you can see that. Now you're doing the scoping of the lines, and correct me if I'm wrong, but it sounds like what happens a lot of times is the scoping of the lines is the major lines that are going from whatever the main sewer line into the buildings, but it's not going to snake all the way up through each apartment. And so, the main lines might look all right, and then all of a sudden you buy it, and then you have cast iron pipes that are bursting on the second floor, and then it's seeping down to the first floor, and now you're having to make repairs on two different apartment units. And how do you know that in due diligence? Is there a way?
So between the walls and the vertical lines, you really can't scope those lines. Gotcha. So what we're trying to get, we're scoping lines that are most probable to fail. Those lines under the building are the ones who are most susceptible to ground movement, wearing out, deterioration over time. And the cast iron in the walls tend to last longer. So not that they don't ever deteriorate, but they last longer. So we're looking for the major items that we know might be a problem. And when we scope those lines, there has been a couple of deals where we scope and we find mud and dirt, and that means the line is broken or just filled with roots. That means the lines are cracked and roots can penetrate in there. And so there have been a couple of deals where we had to cancel the deal and say, really, we don't recommend to go forward because the sewer lines are so bad. Definitely a potential deal breaker. Now, you did mention the liner, and that's a new product that's come out. So I don't have personal experience with that on how well that lasts. We typically do PVC repairs when we're replacing any of the cast iron pipes. But it's something that might be an option, particularly as these properties continue to age, looking for other alternatives that might be cost effective.
Right. So what are so that's definitely, for the listener's benefit, if you're looking for your first property, you want to look to see if it's got cast iron pipes for the sewage, or it's got PVC. If it has cast iron, it doesn't mean that the deal doesn't work. It just means that you have to, pay close attention to, the due diligence process when they scope, and also, how much money you're going to allocate to plumbing issues. So
and some of this, it depends on who's owned this prior. And some of these properties, they may be older, but they were institutional investors, and they've replaced almost 90% of the cast iron. That's a surprise. Sometimes you have a 1970 property that was owned by an institutional investor in the 90s, and they changed all the cast iron to PVC. And you don't know that until you scope it.
That's a great surprise, right?
Absolutely.
That's a great surprise. So talk about some of the other red flags, because, business people that, they're focused so much on, making the returns for the investors, paying the right price for the property. But then, a huge impact could be repairs and maintenance. So what are some of the other red flags that you look for when you're doing due diligence?
Well, let's do two, top and bottom. Okay. Right. So first thing is the roof. Everything, if you don't have a secure envelope for your property, water penetration, rain is going to get in, weather. So the quality roof is really paramount. It's really important. And so that's why we bring out a roofer. We bring out someone to check those items, and even see, before you bring out any expert, maybe you drive by the property or you're reading the OM, the offering memorandum. If they have a newer roof, they're going to advertise it. Right. It's going to be in the OM. So it's going to be, we replaced the roof 2 years ago.
If there's no mention, then it's probably older.
Then it's at least, 8 to 10 years old or older. Nobody knows. That's usually when you might have a problem, and you might need to budget for some repairs. So the roof is something where, yes, take a look at it, but get someone out there prior to you purchasing the property, of course. And so that's key. And then the other thing is foundation. And really, so my area is, we cover all of Texas. And so it's pretty common to have foundation problems in Texas. You have different investors from New York or Florida or California, and this is completely new to them. So here, we have a great market, a lot of jobs, but we have some physical characteristics that are a little bit unusual, and that we have foundation movement. And particularly these older properties tend to move even more because the concrete wasn't as highly rated. Your PSI rating, your pounds per square inch, is lower. It breaks easier. It moves, and so that's something that you're going to have to account for some number for foundation. Now, we typically find most properties can have $30,000 to $50,000 in foundation repair, and that's normal. So that's not a deal breaker. That's like kind of normal course of business. Where you have a problem when it's over 100,000 or a few 100,000 in foundation repairs, and you'll see cracks in the walls. You'll see some of this distress. So that definitely can be a deal breaker.
That's what I was going to ask for. For the person that doesn't know foundation issues, like if they're doing a drive-by or they're just walking by the property, are there telltale signs that property has foundation issues?
So if you're brick construction, you'll see the stair step cracks in the mortar joints of the brick, and you'll see gaps around windows. And you'll see when you do maybe you do a property tour and you're looking in the units, you'll see cracks around the windows and the doors. That's pretty common. It can be as bad as where you find the roof, it's actually caused damage because the foundation moves so much. One city in particular, Irving, which is doing phenomenally, for job wise, and it's a great place to. I own a property in Irving, but it also has one of the worst foundation soils, for apartments. So that's kind of a trade-off.
It's interesting that you said that it's common and it's par for the course in Texas. Like, I grew up in Connecticut, and I don't know anything really about. I've been in, due diligence wise, other than talking to people like yourself. But on the East Coast, I remember if somebody said anything about foundation issues, it was like steer clear, like that. That's a problem property, and don't even touch it. But I've invested in some properties, as an LP, where there were foundation issues, and the sponsors went and allocated enough money, and they fixed those foundation issues, before they painted the property and whatnot, and it turned out great. So that's interesting that you say that it's par for the course here.
Because I do, get out-of-state investors, and particularly the lender, right? The lender freaks out. The lender's from New York, and they've never heard of foundation problems. Like, what's the deal with foundation? So they want to make sure you have a, engineering report and all these surveys and all different levels of where they can make sure that they're confident in your plan. But really, this is kind of normal. It's kind of par for the course in North Texas and Texas in general. The key is, do you have a budget allocated for it? And can you stabilize the foundation enough over your hold period? The reality is that some may not tell you, if they're in the foundation business, is, unfortunately, I've had one old engineer tell me, I said, because I used to do single family homes, right? Before I did multifamily, from 2000, early 2000s to 2009, we did single family homes. We flipped houses. And so I'm kind of cutting my teeth on general contracting and learning this business, and had an engineer who we were trying to make sure everything was right with the house. And I said, can you give me a guarantee? And he said, well, yes. Okay, well, give me the guarantee on this work. I'll guarantee you it's going to move.
That's great.
So I kind of deflated, but over the years, I've realized that he's exactly right. It will move over time. You can stabilize it. It makes it better, but it continues to move with the weather that we have, excessive dryness or a lot of moisture. It will just move over time.
That's hilarious. That reminds me of a CEO of a software company, and I was at like a CFO conference, and somebody said to him while he was speaking, hey, he was complaining about their maintenance fees, and he's like, the CEO was like, isn't this a great business? I charge you for the software, and then I charge you to maintain it. And so that guy just responded similar. He's like, I can guarantee it's going to move at some point, So, all right, so we hit on the two biggies, roof, foundation. We talked about plumbing. So we got what? Electrical, AC, safety issues. What's your take in those kind of areas?
So let's talk about electrical, because I see things changing in that area.
Okay.
Now, when you have older properties, anything, 1960s, mid 60s, 65 to like 73, you have aluminum wiring. And we used to, so I've been doing this, 13, this is my 13th year, going on 14 probably in December. but we used to be able to just do what they called pigtailing, aluminum to copper. And that's kind of the older school method of this mitigation. So, if you hear aluminum wiring, particularly for residential, you're a little bit nervous, kind of like the foundation. Like, is this going to be a problem? Right. Well, if it's properly handled at the switches and plugs, it's really not an issue. It's not the aluminum, that aluminum in all its forms is bad. Commercial buildings and new apartment constructions currently use aluminum wire for their main feeder lines. So large gauge aluminum is fine. It was when they tried to use it for a residential application and they use small gauge, and the wire would break and be not durable as copper. And one of the problems with aluminum, when it breaks or becomes bent, it can tend to not conduct electricity. So you have a little bit of sparking where you have that bend. So they did eventually, by the way, improve that quality of aluminum in the 70s, but everyone was so like, aluminum's bad, we don't want it. So it's really that 1965 to 1973, you need to do some mitigation is what they call it. And to cut to the chase, lenders are requiring Alumicon or a competing method, Copalum, which is a way to transfer electricity from aluminum to copper. So Alumicon is a connector. It's a connector that you have copper line and an aluminum line, and there's no heat transfer. So that's the preferred method. That's, again, Alumicon. Now, just a play on words is Copalum. That's a crimping method where they make that connection between aluminum and copper. So you want that transition to not have any heat transfer, and some other methods, according to some studies, allow that. So I say this because lenders are being more strict on their what they have for insurance requirements that they're going to carry on their policy. So they want to make sure this is done the way that they specify. Because I would say just 3-4 years ago that they would allow some of these older methods that they don't allow now.
Gotcha. So I always heard exactly that, like, kind of like the copper, cast iron pipes, look from an electrical standpoint, as a business guy, look to see if they have aluminum. If they have aluminum, see if it's already been pigtailed. And I don't even know what that looks like, but I would ask people, is it pigtailed, right? And somebody that knows would tell me one way or the other.
Well, just to kind of give a visual for your listeners, okay. Pigtail is like a corkscrew, like a pig's tail, and you wind like a corkscrew, copper and aluminum, where they're twisted together, okay. And then you have a wire nut on top. So that's pigtailing.
And you're just doing it at the connections? At the
connections with your switches and your plugs, because you have aluminum in the walls, and then your switch is going to be a copper switch.
So now you're saying that they're requiring Alumicon or Copalum. A couple of questions come to mind. One is,
of course, that's more expensive, right?
Okay, that's what I was going to ask. Is that more expensive than pigtailing? How much is it to pigtail, and how much is it to add this Alumicon?
So you previously could pigtail maybe for $15 a connection. Now it's $25 to $30 a connection. So every time I check, it's a little bit more expensive with the way pricing is going up these days.
Now, what happens? What are the lenders saying for the properties that have already been mitigated by pigtailing? So I understand if it's an aluminum property and they say, okay, we're not going to, agree to pigtail, you got to use this method. But if it's already been pigtailed, is it grandfathered in, or do you have to switch it out?
Not at all. So this is very important to realize. They consider this a life safety issue, and those items are not grandfathered. So just because it was done and it was done correctly according to code, and the city doesn't have a problem with it, but we're finding that you're going to have to upgrade how it was done. Now get this. Okay, I have one of my older properties. It's a Fannie loan, so it's long-term debt, which is good these days, right?
Yeah,
but
fixed rate.
Yes, but they've come back, and so I'm not the only one. I've asked around some other investors. Fannie is kind of reevaluating some of these older properties that are actually performing well, right? So if you're doing well, you kind of get on their hit list, and they redo their property condition assessment. So they bring out their expert, and they're having you, yes, they're having you upgrade. So particularly on the electrical, for example, so we have a property that has been pigtailed, and the other thing is Kolar. You might hear copper and aluminum. Those are devices that we used to use. We're having to change those out to Alumicon, and there's no new purchase. This is just Fannie coming back and requiring you to upgrade these things that were okay when we first bought the property.
That's not even on the change of ownership. That's
correct.
That's like, okay, existing ownership, you've got a 10-year loan with these guys. They come out in year 3 or 4, and they're like, hey, by the way, you got to spend this much money.
Yeah, so this is a couple $100,000 hit that we weren't necessarily expecting. That's why it's good to have capital reserves in your operating plan.
It's also another good reason to have a guy like you on the team, because look, if somebody just went and bought a property and had no idea that was a potential issue, and they hired a GC that said, let's just pigtail it, well, they're putting themselves at risk that all that money could go down the drain. They may have to redo everything. So
absolutely. And I want to touch on another electrical item that's very similar is the Federal Pacific Electric panels.
Okay.
Federal Pacific panels from the 70s and 80s, they mass produced these electrical panels. They're very popular in apartments, and they also called stab lock. So this is kind of a confusion sometimes on, is it stab lock or is it federal? No, it's like your Honda Accord. Honda is the manufacturer and Accord is your model of the car. Well, Federal Pacific Electric is the manufacturer of these panels. Stab lock was their very popular model that they used in many apartments. And we used to be able to do a load test to test those breakers, whether they would trip or not. They don't allow that anymore. And maybe we were able to do a percentage as well. But now they're reevaluating these properties. And in fact, this year in 2022, none of those have been accepted to not be replaced. And I used to be, maybe a couple of years ago, 50-50. And maybe 6-7 years ago, I had a good chance of them completely passing them. So that's something for the new investor to realize. Some of these properties have changed hands and they've been approved by Fannie over the years, and now they're not. So they're like, well, we have a loan. Or I've even seen this on assuming a loan. They've assumed the loan, and as part of the PCA process of seeing where the property is at, they require you to change out these panels. So it's definitely something that is changing with the insurance and lenders that we work with.
What's the cost to change out these panels?
Well, that's where the sticker shock really hits you. They run about $1,000 per panel. So that's per unit. So these are the panels that are located inside the units.
Yeah, I mean, look, there's a lot of investors that are business people, right? They're they used to flip homes. They're doctors, lawyers, engineers. These are the questions you have to ask, and you have to have somebody on your team that knows what they're talking about. You need to, look, are there foundation issues? Are there roofing issues? On the electrical side, what kind of wiring are they using? What kind of, panels or electrical panels are in the property? If you don't ask those questions, you can end up owning a property that all of a sudden, which is interesting to me, that not only on the purchase, the lender inspection on the purchase, but even 2, 3, 4 years down the road, the lender could come back and say, you know what, you need to upgrade this.
Well, I've heard this from a DUS lender, a direct lender to Fannie, and Fannie as a whole is looking to shore up their portfolio to improve the quality of the holdings when we have some of these capital market issues, and where the economy in general is under a stress test. They're stressing their properties to make sure that they have good quality properties, and any that don't pass, they want them to sell or refinance out into other types of debt. So they're looking to improve their portfolio.
That's interesting. Now, can Fannie require you to refi out to another lender?
No, but they'll make it onerous where that you want to, because here's the process. They will require you to put up capital reserves that they will hold in an escrow account.
Gotcha.
And if you cannot produce the money, to put into that escrow account, because, I deal with all types of investors, and some are, undercapitalized, I would say, and some have a lot of resources. And so you want to make sure that, when you partner with someone, that on the general partner, because that's who is responsible, that they either have the resources to do that, to put in the capital. So they're going to hold that in escrow. And if you can't do that, we've seen some deals where they go to market to avoid having to do these repairs.
So, I'm assuming that's part of the lender docs, that were signed at purchase. There's little writing in there that allows them to, increase the reserves based on, repairs that they deem.
So you talk about investors coming from other areas, they maybe know finance and not know due diligence. Well, this is something for me as an investor. I didn't know the intricacies of lending, capital markets, and these lender contracts absolutely have a lot of fine print where they say, you find out later, they can pretty much do what they want.
Do what they want, right.
Now we've learned some of those are negotiable that we didn't negotiate at first, but really, the lender controls the deal. And so you want to make sure that they're happy throughout your hold period.
Yeah, absolutely. Well, thank you so much for sharing all those issues. When I was walking with you, I was so naive. I remember we're walking past and there was dripping coming out of some pipes out on the outside, and I don't remember what the issue was. It was an overflow or whatever. I don't know if it was for ACs or for the hot water heater, but it was great to have somebody that knew exactly what that was, and hey, you just got to budget for this, or you got to do this, and you have no problems. Let's switch over from the maintenance side to, look, you still do all these due diligence work, your company, but you also have gotten involved with buying properties. You have 3 large properties for 832 units. So one, why did you make that decision to actually become an owner? And then 2, what are kind of some of the learning lessons, from being on the other side of the table?
Well, I always wanted to be an apartment investor. I mean, before I was able to do it and had the capacity to do it, part of the reason why I went into due diligence and moved particularly into apartments specifically. So I don't do any residential. I mentioned we used to flip houses. We weren't very good at flipping. We were more of like a slow back bend. We typically did higher end houses, and so they took a little bit more time. But when I knew that I wanted to invest in apartments, that's where I switched my due diligence and GC business to only focus on apartments, just to be around those investors. So it took some time for me, frankly, to build up the capital to be able to have something to invest in the apartments. But that was always the goal. It just, once you've done single family and you realize that they're valued on just a comparative market analysis, and you see the power of the cap rate and being the value is based on a multiple of your income.
And that you have control, there's forced appreciation. So where you could have two properties right next to each other, and if you're managing your property really well, valuation can continue to increase, and the one right next door may be poorly managed, and NOI doesn't go anywhere, and that one's going to stay same valuation, even though they may look comparative.
Exactly. And so that's really why I wanted to always be, for the last 20 years, be an apartment investor, and have been able to do that for the last 4 or 5 years. And we'll continue to do that. Right. So you talk about some of the lessons learned. Is one, how vital operations is. It's not just getting the deal. It's then asset managing and the property management company is so important.
And everybody says that going forward, that's going to be more and more and more important.
I completely agree. As so I get the benefit of being on the sidelines at the beginning and at the end of some of these deals. And, a lot of investors had tremendous success, but I kind of see behind the scenes. I'm like, they did it by, the skin of their teeth, kind of by the seat of their pants, as far as they didn't know anything, but they were successful. I just don't think that's going to be the case over the next several years in this economy. I think there's still money to be made in apartments, and it's a great investment vehicle, but you're going to have to really have a good team put together. And this is a good part to interject, where I'm a numbers guy. I have a degree in engineering from Baylor. I did that for a few years, and then went into real estate and found what I really love. And so I'm always numbers based, but as I become, more experienced as an apartment investor and try to grow my business, it is putting those teams together is really critical. Like, how well do you work with a property management company? And if there's problems in the property management company, it's because they haven't put together a team effectively. What's your ongoing training? How do you bring in new people? And so right now we have, a shortage of good quality candidates for managers, maintenance. So what's your intake? Well, I have the same issue on my due diligence business. How do you put together a team? How do you keep them motivated? And I'm finding that these soft skills of leadership development, team building, kind of emotional intelligence have greater value than I ever thought. And I was more of a numbers focused previously. So that's a big lesson that I've learned over the last few years.
Yeah, I think that's huge. I mean, everybody says that multifamily is a team sport, and there's just so many people that are involved. And, if you're not good with people and building a team, then partner with somebody that is. If you're the guy who's really good at, finding deals and building relationships with brokers, then partner with somebody that's the underwriter that's going to underwrite all the deals. You don't have to be all things. Figure out where you're good and where you can add value, and then find other team members. Some of those team members could be partners. Some of those team members are investors that are going to invest in the deal. And some, like you were saying, some of those team members are third-party companies that you're going to work with.
And you're building a relationship, right? It's not just transactional. It's not just one time and you're done. You can work with these companies over the years, the same as you do with a preferred lender. and, preferred partners.
That's what they want. And that's what you want. Like,
Absolutely.
The vendors would much prefer to talk to you about 5 different properties in one phone call than, talk to 5 different people about 5 different properties. Right.
Absolutely. Yes.
So what are some of the, the soft skills, before we hit record, you mentioned something about some giveaways that you wanted to do. Do you want to maybe share that with the listeners in terms of how they can get some of those giveaways? Because
you talked about, you talked about how when I walked with a property with you, that it was so beneficial to kind of point out things and kind of, this is one way, this is another, depending on your business plan. Well, I can't do that with everyone.
Right.
And so I've done a couple of trainings, just a couple of short video trainings to show the investor how to drive by a property and start putting together that renovation budget. So before you have, gone down the path and you've hired someone like me for due diligence, that's already down the path, a ways. And, remember the days of, hard money, that's still around. And now you want to make sure that your property's in good shape so that you can get to the finish line with the lender. So I have the training for how to do a drive-by, what to look for, what to evaluate, and then also a subsequent training, additional training for how to do a property tour. You're touring with a broker, you're seeing the property, what are you looking at? And so a couple of trainings I'd like to give away, and I use Community.
Okay.
So you can text me at Community, and once you give me permission to send you that link, I'll send you those trainings.
So what's the Community? So they just text to this?
It's my text number. Yes.
Okay. What is the text number?
So that's 214-833-6450. Again, 214-833-6450. And once you text that, text podcast, and I'll be sure to get those trainings out to you.
That's huge. I was just talking to a new investor. Well, she's trying to become an active investor, and she was asking me, hey, will you go on some property tours with me? And I was like, I'm sorry, but no, I'm just too busy and I can't do it for everybody. Right. So, I'm like, there's fear, right? I can tell that she's afraid, and I was afraid, that first time, going, what do you say to the broker? What is the broker going to ask you? Like, you don't want to look dumb. You want to, and I'm like, look, at the end of the day, you're going to get better each time you do it. But if you don't do it, you're not going to get any better. Right. But I wish I had this resource I could have pointed her to give her a little bit more confidence. So that's great. So thank you for sharing that with people.
Okay. One tip I'll give on a property tour, that I've learned is do go with a buddy. Go with someone. So you as the investor, you really have to sell the broker that you're a good person that can, you have the wherewithal, you have the team, you have the capacity to buy the property. So part of your job is convincing the broker during the property tour. And then the other part is evaluating the property. So that's 2 different roles. So if you can have a buddy, just take some notes on what they're seeing while someone has the conversation with the broker, you can get the most out of that property tour.
That's a great point. And that's exactly what I've told other people is that, look, going on a property tour, there's a lot of different things that are happening. One, you're seeing whether it's a property that you want to, invest more time with and try to win. But it's also, you're evaluating the broker, or do I want to do business with this guy? And he's evaluating you. Is this person capable of closing? Or am I going to put him at the back of the list? So those are all great points. Look, you've done so much. I'm so thankful that there is this resource. This is another advantage of joining a multifamily mentorship group or a mastermind or going to free meetups, getting around people that have already, like if you want to, your goal is to buy apartment buildings, get around other apartment owners because they're the ones that were like, you got to hire Bryan. Like, and then you learn that and then you got to hire this legal firm. You need to hire this property management company, and you learn from other people. You have to get out there and do that. So what's your next big stretch goal?
So I'm looking to, I've been in due diligence for a long time, and I've kind of stayed in the Texas market. I want to expand. So
you're going to go outside of Texas?
Absolutely.
Awesome.
So that's really my goal. As like you mentioned, I have a business coach. I have masterminds that I'm part of, and they're like, "Why are you staying so small? Why are you staying in Texas?" It's like, so I want to expand. I want to expand in the Sun Belt, where I want to potentially invest in apartments, and be able to service those clients. So really, I want to grow the due diligence, and then take that excess capital and invest in apartments. So in what I know and love. So that's my next thing is we're first expanding to Florida, and that's really on my target list. We have family in Florida too, so
just saying it is a risk, right? I mean, you get into this world and you get around so many people that just keep pushing themselves and keep pushing the envelope in terms of what they can accomplish, and when you see that, it motivates you to do the same. But, when we talk about growth, like doing stuff that you haven't done before, is where that growth is. It can be scary, but it's also like when you look back, you're like, oh, cool, I did that. Like, so you don't necessarily know how you're going to accomplish it. You just know you want to have, grow your business in the Sun Belt, and now you got to figure out how to do it, cost effectively.
Absolutely. So that's my next big stretch goal.
So if listeners are, because the listeners we've got first time investors, we've got syndicators looking to scale. If there are syndicators that are scaling and they're maybe they've bought in Texas, maybe they've actually used you in Texas and they don't even know that you have interest in doing business outside. So if they're going to do business in, what would you define as the Sun Belt? Florida, Georgia?
Right. Nashville is still, though, Carolinas.
So if you're going to be in those markets.
If it's snowing right now, we probably don't go there.
Right.
We're approaching Thanksgiving, right? This time of
year. And what would be your requirement? Like, is it somebody that, are you looking to move into those markets with somebody you've already done business with? Or if somebody's listening to this and they have not done business with you, should they call you?
Absolutely. It's really the size of the transaction that makes it possible.
Okay.
Right.
So
if you're looking at anything over 200 units, it makes sense for me and my team to potentially go out there. If it's 12 unit complex, 30 unit, I really can't, because of how our business model is set up. Was we're paying these trades, right? So to come out there and provide a service, that's why you're not obligated, because sometimes you do it for free, but they're waiting there for you to
well, the other hard part for you is like here, like in any of the submarkets in the major metropolitan Texas markets, who the trades are that want to work in Irving or Fort Worth or Dallas. But like if you go to Jacksonville, like you got to build relationships with the different subs in those markets, and so. You need to have a big enough investment to make that worthwhile.
Absolutely. And, after doing this for a few years, we kind of know what to look for in a sub. And so, but it is reaching out and creating those relationships so we can put together teams like we have in Texas in other states.
That's awesome. Awesome. Well, I wish you much success on that front. Hey, what about for fun, like outside of work? What do you like to do?
Hey, we actually just came back from Branson, Missouri. And so I love to travel with family. We did a couple of weeks there. I know you're traveling all over the country. So similarly, we love doing that. We love to travel. We love to be in new places, but with family. So we homeschool our kids.
Oh, awesome.
And so
how many kids do you have?
We got 3 kids.
3 kids. What ages?
8, 11, and 12. 12-year-olds. About to be 13. I'm going to have my first teenager here in a couple of months. Unbelievable.
Homeschool. That's tough, right? I mean, that's a big commitment.
So my wife is a superhero. I admit it, right? But we wanted to, kind of the way we want to take care. We want to be responsible for our income, right? So I have my own business. I choose my own investments. I want to be responsible for our own education as well, to make sure they get a quality, well-rounded education. And so we do school on the road. We do school, when we travel. So, and it allows us to have that flexibility to do that most can't do.
That's awesome. So if people want to reach out and get to know you a little bit better, first of all, thank you for giving that text message of 214-833-6450. Is there a website or someplace else that listeners can go to learn about your company and a little bit more about you?
Yep, absolutely. Go to theomnigroup.com. That's TheOmni group.com. So theomnigroup.com. And that's where we're located.
Fantastic. So, Bryan, one, thank you for working on our deal and helping me, coaching me and advising me. Look, listeners, if you've got properties and you don't have somebody like Bryan on your team, that's a big mistake. So definitely look him up and get to know him and his group and his team members. And until next week, signing off. Thanks, Bryan.
Thanks, Darin.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.